Welcome back, guys, to another roundtable. My name is Adam. I have Rusmin.
Hello.
And Victor.
Hi, everyone.
Thanks for joining us. Today, we're going to talk about Singapore REITs and specifically the top 10 Singapore REITs that would have made you money and how much, in terms of returns and dividends, if you invested from the time of their listing, their IPO. All right, so we've actually been doing this study for 8 years. Or Rusmin has been doing it.
Yes.
And every single year, we actually write an article that updates the results of all these REITs that pass our criteria, basically. It's a very simple criteria. You will talk about that pretty soon. But we have a table that basically lists their returns over, since they listed all the way till date.
Yep.
All right, so before we jump into the results and the top 10 REITs, Singapore REITs, maybe we can explain what the methodology is all about.
The methodology is actually very simple. I go back to their listing year and the date at the price where they actually got listed, right? So, and from there, I will then add on the dividends that you're going to receive every year from these REITs. Okay, and on top of that, of course, the current price of that REIT itself. Okay, so that's, for example, a REITs that got listed at $1, and then right now, they're still trading at, let's say, $1, for example. Right, but along the way, you may have collected the dividends of 50 cents over the course of 10 years. That would be your initial figure will be like $1, or let's say you put $10,000. That means that you're going to end up with $15,000, right?
Okay.
So then $5,000 alone is actually come from dividends.
Okay.
Yeah. So that itself, and then I will analyze it.
Okay.
As simple as that.
So you calculate the CAGR as well.
The CAGR.
Because different REITs have different history. Time frames.
Yes.
So you're going to see what doing better in terms of CAGR.
And the result is exclusive of those dilutive rights and placement, right?
Yes. Yeah. Okay. So basically, if there's any rights that taken place, I never take that into account. Basically, I didn't assume that the person, or let's say if you're an investor that REITs, subscribe to the rights.
Okay.
Yeah, because I have the inspiration to do this calculation of return mainly because in the past there used to be articles saying that if you invest in REITs, the REITs will keep coming back to ask money from you. Right. So I do an assumption where if you invest in REITs, you do nothing. If there's a dilution, you let it dilute. This is what you're going to get.
But if you subscribe, the return will be higher.
It'll be higher.
Okay.
Yeah.
All right. So this is a very bare bones test. It's very simple. Basically, from the listing all the way to now, what is the price, any capital gains, and the dividends along the way. That's basically it, right?
Yeah.
I think one key criteria is that we only include REITs with a listing history of at least 10 years.
10 years.
So there's some time frame to that.
Yeah. So I don't want to include those REITs that just got listed or to only have a short listing history of 3 to 5 years. In fact, I want to do a 10 years record because I want to focus on long-term result. And in fact, a lot of REITs that got listed recently, some of them got into trouble. So I want to make sure, I think long-term measurement 10 years is sufficient to tell whether that REIT is a quality REIT or not.
Okay.
Yeah, so from that, I stretched back all the way to 2002, and there was very first REIT that got listed was CapitaLand Mall Trust. Right, then from there, I started to calculate their dividends that they pay out every year. And then, of course, the listing price that they have, and then cumulative dividends plus the share price. And then from there on, I calculate the return. Right. So, of course, then there are more listings like Ascender, Suntec. And along the way, of course, we have more REITs that got listed in SGX. And from here, you at the table here, you can actually see these are the list of REITs that have a listing record of at least 10 years. Some of them are more. Okay. So, like CapitaLand Mall Trust now is known as CapitaLand Integrated Commercial Trust. Okay, they have a listing history of I think 22 years.
2 years.
Yeah.
22 years almost,
so it's pretty long record over there. Okay, I think we can actually see that the top performance are actually Capital DC REITs, which got listed in 2014, and this is the newest addition that I added this year. Okay, they got listed at 93 cents, and of course the amount of distribution that they pay out is about 69.3 cents, right? So, and at the current price, based on 31st of December, it's about $1.95. So that works out to be about, I think, total return that you're going to get is about 184%. Okay, which means that if you invest $10,000 in Capital DC in 2014 during the IPO, okay, the amount will balloon up to close to $21,840.
Okay.
Yeah, so that is quite a good return over the course of 10 years.
Okay, so this includes, like you said, dividends, everything, right?
Everything, yeah. And of course, the current share price, the value of the holdings that you have right now.
And this table that you have, the table that you're going to see, that you're seeing, is basically the results, and you rank them according to CAGR, right? Is that correct?
Yes, yeah.
Okay.
So the highest performer is going to be a Capital DC, which comes in at about 12.3%, and then followed by Mapletree Industrial Trust, which is about 11.8%. And then Parkway Life REITs at 9.5%, Mapletree Pan Asia, CapitaLand Ascenders, Mapletree Logistic, both, all of them mostly at 8 to 9% range. And of course, the top 10, the cutoff point is going to be your CDL Hospitality Trust, which comes in at about 6, almost 7%.
Okay.
Yeah.
So this table that you see is basically all of the REITs that have at least 10 years of listing history. Not all of them are positive,
Yes.
but a lot of them are. You see a lot of green on that table. And I think one good point I can bring up about REITs, I think some people may think that REITs are very slow in terms of returns because it's a dividend play. You earn 5-6%. There's limited capital growth, stuff like that. But if you look at the tables, look for example, Capital DC REIT, a CAGR of 12% is pretty impressive.
Yes.
So it's nothing to sneeze at. It's almost, I mean, the S&P 500 is 10% CAGR.
Yep.
I mean, that's over a very long history, and that's tremendous.
Yeah.
But just an isolated example in terms of Capital DC, and it's not just Capital DC. There are other REITs there that have very decent CAGRs when you include the dividends and the capital gains.
And of course, different years you have different top producer, but I think consistent winners are those that have been, in many years of tracking your Ascenders REITs, CapitaLand Mall Trust, which is now as Integrated Commercial Trust, Fraser Center Point Trust, Parkway Life REITs. Some of these REITs are the consistent performer throughout every years of me tracking them.
Okay.
Right. So these are the outliers. So I think they have done or deliver quite an impressive result, even though REITs produce a lot of people think that it's low, right? But it's been very consistent. And this REITs actually gone through a boom and bust, right? They have gone through, a lot of them with a listing history of I think 15 years, which they have gone through 08, 09. They have gone through in that time when the rate was rising. That was in 05, 06, 07. And of course, subsequently, the interest rate went back to zero, right? And then started rising again 2018, 2019, and then COVID came, and then it reset. And now recently, even now, right now, at the time of this recording, the interest rate is at all-time high.
Okay,
again.
so despite all of these events, the good REITs are still doing well. Based on a historical basis. And I think we need to zoom out in terms of REITs. You need to see over a period of time. It's not like some hyper-growth stock that you want to get in and out in a year or two. So we need to zoom out, and 10 years is a pretty good time frame for REITs, and it's doing pretty well in terms of Singapore REITs. So when you look at the table and you see some good, great winners and some in the red as well.
Yes.
So maybe let's pick up some insights from these results. What are the similar threads among the top REITs? And why are some of the REITs in the red?
The bottom REITs are all foreign REITs.
I wouldn't say all, but majority of them, right?
Okay.
So let's talk about the losers, right? So I think this year calculation, I think we have 6 of them or 5 of them that are actually in red. Our dump Savannah is red because even though it's showing green here, but based on today's price, it will probably be red. So there are 6 of them that didn't do so well, right? So Savannah, Fraser Hospitality, and of course Makataku Industrial REIT, they have assets primarily in Singapore, right? And then the rest, iREITs, OUCOM also have assets in Singapore, but Lipomo, and iREITs is mostly outside of Singapore, right? So if you look at the reason why they didn't do so well, of course individual REITs have their own reason, but a main reason for foreign listed REITs, which they have assets in foreign countries, they are listed in Singapore. One of it, if you look at Lipomo, I think about the assets are actually in Indonesia, right? So, and this is a country where the currency can be very volatile and it's depreciate over time. Right, I can tell you that by experience. When I first came here, $1 Sing is about 5,000 rupiah, and today it's almost equivalent to 11,000. It's depreciated by more than half. So Lipo more in that category where there's a very strong headwinds. And if you invest in REIT, you started to see your DPU coming down, primarily not because of that lower rental. I mean, that also attributed to the loss of why the reason the REITs actually come down, right? But the large part of it is actually because of the currency headwinds. So I used to invest in Lipo, right? But at 1 year, I still remember it was 2012 or 2011, the rupiah dropped 20% against Sing dollar, and that's the time where I sold.
Okay.
And then I realized that emerging countries, especially those REITs that have a lot of their assets are in like Indonesia, or even India, I wouldn't touch them.
Okay.
Because you are going through a very strong wave or current.
Yeah.
Okay.
Yeah.
I think you have to really check how is the currency performing to, let's say, because we are Singapore investor, performing to our Sing dollar, right? So if the country currency and our Sing dollar throughout the years have been quite stable, I think it's still okay.
Okay.
But because Malaysia and rupiah has been, the ringgit and rupiah has been depreciating against the Sing dollar for a long time, right?
Yeah.
So over a long term, it may seems like you're fighting, like what was me say, a headwind. But not say that you cannot invest. I mean, sometimes the REITs can become so cheap that it does give you some sense to look, because the valuation is cheap. But just that you must have the mind that you knows that, okay, I can invest in these REITs, but it's short term, not long term, right?
Okay.
Don't buy and hold such REITs like over a long period of time. Yeah.
And of course, the REITs that are not in the list are like your Saizen REITs. I think those are the days where they own residential property in Japan, and but Saizen also got into trouble during 0809, okay, because they have problem refinancing some of the loans that they have. And so then after that, subsequently they were being delisted because they have sold their assets, right? So I didn't include them here, okay, but Saizen also lost quite an amount of money, okay. And the other one is of course your Makataku Industrial REITs, okay, which is now known as AIMS APAC REIT, okay. So that REITs also didn't do quite well, also because of the 08, they were 0809, they were very aggressive, right, with the previous manager, and they over leverage, and when the subprime hit, okay, it was very difficult for them to refinance the money, and the cost of capital has gone up also because the share price have crashed so much, okay. And that time they have to look out for white knights, and so those were the REITs where they didn't survive the crisis, okay, or they may have they survive, but there's a change of management, there's a change of ownership. So those were the losers that have cost the REIT scene. I mean,
but there's also some REITs where they have like management issue, like it got into a very big news like Sabana and all this, right? So sometimes when REITs, especially when the management issue surface, people feels that the management is not shareholder friendly, don't think on the interest of shareholder. One trust is loose, it's very hard to win back. Right? So that, I think for the case of Sabana, I think it underperformed because I think that investors still don't really trust, even though they already changed already.
I will even include OUE REITs in this because I've attended many times of their EGMs, and I felt that a lot of deals that they do were not really prioritizing on the per unit basis. It's more like growing bigger and bigger, but it doesn't matter whether the DPU diluted or not, right? So that contributed to the why OU Commercial Trust, even though they have a lot of great assets in Singapore, and yet they didn't perform.
So we've been focusing on the ones that didn't do so well so far, and it seems to be a management. Sometimes it's management just basically,
and the assets that are located,
where they're located. And I think the big one is basically sometimes they're just too aggressive. And when the market shifted, like in the 2008 financial crisis, they just got hit really badly. So these are some of the examples here. So what about the good ones, the top 10, the top 5? What did they do so well that allowed them to basically do so well over a long period of time?
So I think the thing about just now Rusmin says that the top 10 they shift throughout the years, Some become number 1, then become 2.
But they're still among the top. Right?
But like right now you see the number 1 is like Keppel DC, Maple Tree Industrial Trust, and these two, right? I mean, because I think in the recent years there's a investor focus a lot on the data center, the growth industry, right? So I think that also might contribute to the CAGR returns for them in this topping this year. Last year, 2023.
So they're at the right time and the right place, right? So I think I remember 8 years ago when I did this calculation of return, the top 10, top 8 of them, we are still seeing it here today, namely I think Ascenders, CapitaLand Mall, which is Integrated Commercial Trust now, Escort, Fraser Center Point Trust, CDL, Parkway Life REITs, Maple Tree Lock, and CapitaLand Com, which merged together with CapitaLand Mall Trust, right?
So Maple Tree Commercial, was it there as well?
mandatory. It wasn't there yet because they didn't have the 10-year
listing at that point.
When I calculated it was in 2016.
Okay.
Yeah, so they didn't have that 10 years, so I didn't include that here. Okay, so but now of course they're in the list. Okay, because they have achieved that 10 years listing history, right? So. Okay. Now, what is consistent throughout all these EEC performance that we still have it today here is that, I mean, they own assets primarily in Singapore, right? So that's the key number one. And of course, assets, they are in the good location and they are well managed. Yeah, so then of course, they do have the managers whose interests are really aligned with you, right? And when any deals that they come along, they will make sure that it is yield accretive to the unit holders. If they are not yield accretive, right, then they don't go ahead. And a part of it, like for example, Frasers, I mean, they are really good at doing fundraising. Okay, they don't issue rights at the distressed time. Okay, they do a lot of small placement along the way, when their valuations are at a very good price, and they raise the money and then they use it to buy yield accretive properties, and then as a unit holders, even if you don't subscribe to the rights, or even if you don't do anything, or you don't subscribe to the preference offering, you are still not diluted, right? And then you get to see your DPU going up and up.
Okay, so you're not diluted in terms of DPU.
Yeah. Okay. Even if you don't contribute, after you invest, you don't contribute, do nothing. That's the table, the purpose of this table, right? You don't do anything with your REITs investment. Yeah. So these are the REITs where they have a good managers, good assets, and financially they are well managed. So they don't take on a lot of leverage. They have the room, right? I want to make sure that we are not overly leveraged. Our gearing is always like 40%. That's the max that we will go. You will hear. We don't grow for the sake of growing.
Okay. We
grow only when it makes sense to the unit holder.
So there's an opportunity, a good acquisition, you are accretive, then they move.
Yes. Okay. But you can hear from the tones of the management, right? They are more aligned with you.
Okay. Yep.
Yeah. These are what I like to invest in such good REITs.
I think one point I can bring up is that we've attended a lot of AGMs for Singapore REITs. Three of us. I've attended so many. But let's say based on your experience, the both of you, all these good and well-managed REITs, what are the things that you can pick up when you attend the AGMs? What is it like for you?
The first thing is that when I start to go into the REITs and they are telling the unit holders, we want to grow the AUM to this amount by this year. That's a red flag.
Okay, that's a red flag. Okay.
Because to me is that when you go to this type of AGM, you hear question from unit holders, why are you not buying more asset? Okay. Then the manager say, because we couldn't find a good deal. We actually have a lot of deals, but they all doesn't come at the right price. And when we do our math, we realize that it will be dilutive to you, so we don't buy them.
Okay.
Those are the kind of tone that you get. Do you know that these guys are with you?
Okay. The asset increase, but the DPU keep decreasing.
There's no point if the DPU goes down.
Yeah. Right? There's one risk there's like that's in the list. You can go figure out. It's not definitely not the top 10, but it's in the middle.
Yeah. Okay. They grow and grow and grow. Your DPU come down, and then their fees keep going up.
So if you have been to the AGM, you know which REITs is it.
Okay.
Right? So and it really reflects in their performance.
I think I have an idea of who you're talking about. But anyway, so I think capital allocation behavior, in the sense you're saying, is very important.
Very important.
Yeah. Because it's basically a REIT is managing assets, managing
money,
the money to invest properly. So that is basically the key role. If they can't do capital allocation properly, then I think they're not doing.
So what happened with Alco or even Makataku Industrial REITs in the past, where they were primarily focused on growth?
Okay.
Not quality growth, but the growth of AUM. So and that would translate to higher management fees.
So growth's sake. Rather than the DPU for investors.
This one is there for their own interest, because higher growth on the AUM is they got higher compensation.
Okay, I can't say that, right? But the fees are structured that way.
Correct.
Okay.
Yeah.
But I think at the end of the day, I think because REITs are basically primarily an income vehicle. So for us investors,
they can do it short term, right? But then mid to long term you will show up. Like those REITs that screw up, I think you show up in 0809, they get caught, right?
Okay.
Yeah.
But I think it's like what Charlie Munger always say, you look where the incentive is.
Okay.
Right. And if you find somebody who knows that this incentive has loophole, but he don't take advantage of it, that's a good person.
Okay.
Right. So, but if you know there's the incentives like this, then you continue to expand, increase your AUM. Then, which side are you in? Are you on your own salary side, or are you on your shareholder side. But as a risk manager, you should be on the shareholder side.
Yeah.
Right?
Okay.
And the other one I do want to mention is that first REITs was in the list 8 years ago.
Okay.
And their return is about 13.6% CAGR.
Okay.
And they got listed, I think, in like 2006. Right. So they have that 10 years listing. And it was the highest, the best performer at the time.
Okay.
All right. So, but what caused them to drop to, I mean, if you look at the latest calculation, first REIT actually dropped all the way to more than half.
Outside the top 10, right?
Outside the top 10, right? So, but it's the CAGR now is only like 4%. Okay. So the reason is primarily because of the structure. The day when they got listed, they told the tenants, right, you can pay the rent in, because they are based in their own hospital in Indonesia, right? They are supposed to pay rent in rupiah, right? You don't pay US dollar, right? So you pay rent in rupiah, but because when they listed, they say that, oh, rupiah, there's a currency risk, so why not we get the sponsor to come in and guarantee that in Sing dollar, right? So sponsor agree to take on currency risk, and then first REITs really enjoy in the first 15 years. They really enjoy that, because it's a master lease.
It's backed
right?
like by the sponsor. They're hedging it.
They are hedging it.
So
for
if
you.
the rupiah depreciate, the sponsor will cover
the difference.
Cover the losses.
Yeah.
Okay. And over time over the 10 years or 10 over years, right, now they have actually restructured it, right? But the losses has widened. It's like you're talking about 20 million.
I think the sponsor didn't expect this thing to happen.
Yeah,
Okay.
the currency risk to go so far off, right? And so that why it dropped so much is largely because of that unsustainable lease structure that they have with the sponsor.
Okay.
Yeah.
Okay. So what else? Anything else about the good, the good top 8 REITs that you can see?
So these are the two common things that I think you will see, right? You need to invest in REITs that have quality assets, right? And when we talk about quality assets, we are talking about the tenants, location of properties, the lease structure that they have, and whether they are sustainable or not. Of course, the occupancy, all these metrics that you really need to learn. Of course, it's going to be a long topic. I can go on and on. Okay. I mean, we do have that dividend machine that now we are actually live.
Okay.
Where you can join us. Which I will go into really dive deep into on how to really find quality REITs using the system that we developed. We even have like a 4-page checklist to make sure that the REITs really pass on that criteria.
Yeah.
And also the valuation part, I think. Because if you look at Parkway Life REITs, right, Rusmin put the returns is about 9.53%. But after he taking the IPO price, but after the IPO price, 0809 happened and he crashed all the way down.
Yeah.
So if you have bought during that time based on the right valuation, your return should be more than 9.5%.
Yeah, because this study is just very simple.
Yeah.
Just IPO to now. But along the way, there will be opportunities to pick up the REITs as well.
Same for the Mapletree Pan Asia.
Okay.
Yeah, along the way, they really give you opportunity to buy into them, and you just ride it upwards. So and the valuation get more expensive, then we sell.
Yeah.
Okay.
So for like good example, like Victor mentioned, good point. Parkway Life REITs here return is 10.8%, right? Rather in this latest one is about 9.5.
Okay.
We are getting I think teens, CAGR, mid-teens, 14-15%, right? But largely because you got it at the right timing. Yeah. So valuation comes in very handy. You got to know when is the best time to invest in REITs and when is the best time to exit them.
I think it's very important.
Yeah.
It's not handy, it's very important.
It's very, very important. And actually, we have one former student, which is still in our alumni, right? So I still remember Jonathan, and he told me that he commented on my articles, right? So, and he wrote that, the biggest thing that he learned in this dividend machine is actually how to identify the best entry points and what makes particular REITs a better bet than some others. And he actually get a better return than what the table that's shown. I actually shown it to all of them.
All right.
Yeah. So this valuation is also really important. You really want to make sure that, I mean, the table that I compute is based on IPO price. Okay. So some REITs, if the IPO too high, of course your return will be lower. Okay. So if you're a REITs owner, don't IPO too high.
I mean, this is almost like a study on a passive investor.
Yes.
But as a more active investor, you can get higher returns than this. And this is actually pretty good already when we saw the CAGRs here for REITs.
Like you said, the most REITs, they IPO at higher price during the IPO.
Yeah, most people want to sell high, right?
Yeah.
Because they need to raise as much funds as they want. It's not that they want to against the investor. But that's how the markets works, right?
So one rule is that I usually don't invest in REITs IPO. Yeah, because REITs are not like your tech where once they list it, if you missed it, that's it. The next moment, got double up, quadruple, you won't get it.
It's a different asset.
It's a different asset. It's slow and steady, and then over time, because of the higher rate environment or lower rate environment, the valuation will change, right? And if you got in, you can always join like 3 years or 5 years later after the listing. You may get in at a better price.
You also need to track the management.
Yeah.
Right, because when you
right?
IPO, how do you know you can trust that management?
Yeah.
I just got to know you. How do I know I can trust you? But if I with you for 5 years and I see your character, then I know whether I can trust or not trust you. So same for the REITs. You want to trust the REITs, you have to track the management for 5 years.
Yeah. Right? So we haven't even talked about Eagle Hospitality Trust. There are a lot of things to talk about, but I think in a nutshell, you really have to find good quality REITs to invest. Okay, because what I can show you from this table is that not all REITs can become a good investment. You can't just blindly go and buy those REITs that have high yield, right? So right now, if you look at the REITs that we compile on a day-to-day basis as REITs data, you get to see that a lot of US office REITs are now trading at 20-30% yield. Yeah, but this is based on historical dividend. And all of them, 3 of them now have announced stop. They stop their distribution, means no more dividend. So that 23% is gone.
It's gone.
When something is too good to be true, it's never true.
Okay. So I mean, if you're interested to find out how you can build a portfolio of your own REITs for you to earn passive income, and of course get returns like that, and if, like you said, valuation is very important. Do check out dividendmachines.com. It's open from now till 17th of March, 2024. So I don't know when you're going to watch this, but basically it's an online video course. You can go through the entire course at your own time, at your own pace, and learn how we actually do all these things.
And come with a 1-day live webinar.
As a live web class as well. With Usman and Victor.
So I think this is really also a great time for you to look at REITs, because the currently markets are not interested in REITs because now we are in the high rate environment. And the good news is a lot of REITs in Singapore, even the good ones, are trading at a very cheap valuation.
Yeah, that's the thing. I mean, now you don't hear a lot of news or anything on the REITs front. It's kind of quiet, which to me is actually maybe it's time to have a look at something. Because it's actually quite stable. It's not a very volatile asset class. And if the yields are decent, then you're being paid to wait.
And the interest rate is expected to come down, which is going to benefit the REIT.
We don't know when that is going to happen, but right now what we know is that the REITs, the whole sector in Singapore REITs itself, if I were to weigh them based on price to book, now they are all on average they're trading at -2 standard deviation, which is attractive.
It's very
cheap. It's very attractive.
This is based on price to book, right?
Yeah, because at the end of the year in 2024 there was a rally, that almost got back us up to where we were, compared to last year. But now, because of the recent sell down again, I think the REITs become more attractive again. So it's really a good time to look at it. And when the rates start to come down again, that's the time we start to see the prices of REITs may go to the other opposite direction. They may appreciate.
All right. So you feel it's kind of like an opportune time to have a look at REITs at this time.
But you need to be very selective with the REITs that you want to invest.
So I think you still need to do your research on REITs, because as you can see from the table, there are really some good ones and some really not so good ones. So you can't just throw a dart. Hope to pick the right one. There's certain things you need to go through to find the right bunch of REITs.
Only the top 10 beats your CPF 4% by 2% extra.
That's true. So at this point, so let's say any particular REITs that you want to bring out as examples of they're very decent yield at this time, but no one's really looking at them. It's kind of quiet, but actually nothing's wrong with them.
I would prefer to, let's say, mention one of the safe one. I would say that the very first REITs that got listed and have a very long track record, and that will be a CapitaLand Integrated Commercial Trust. Right, so you're owning a bunch of shopping malls in Singapore. Most of them are prime assets like your Plaza Singapore, Raffle City, City Hall, and so these are the few assets. You have to go and look at it yourself. They have quite a number of assets. They also have own Grade A offices, primarily in Singapore, and those two sectors now are benefiting from opening up the post-COVID environment. So tourists are coming in, so they will benefit from higher traffic footfall.
Taylor Swift is here.
Yes. A lot of people will be spending. Tourists coming in and they're spending as well, and that will benefit this particular REITs. Okay, and yeah, so they are also very well managed. Capital structure wise, they are also very safe. I mean, if you want to have interested in all these metrics, of course you can go and dig out yourself, or if you don't know what we're talking about, you can look at Dividend Machine, where Peter and I will really teach you on how to analyze the REITs, right? And we're
also other dividend type of companies.
Yeah, and we'll hold your hand. We really go through with you the annual report and show you how do we know this is good REITs, right? So, so those are the things that we go through, right? So so CICT at this stage, okay, I can spend another 30 minutes, 1 hour talking about CICT, right? But at this stage, the yield is about 5.6, 5.7%. So I think it's a decent yield, okay, and obviously if you compare with your Singapore saving bonds, 3%, of course that is risk free. This one has a little bit of risk, but also capital gain upside, okay, also downside. Okay, if the interest rate were to continue to go up, right, so you may see a lot of pressure in the share price. But I think we all can pretty much agree that interest rates are more or less topping up, right? So it's the next moment is when it's going to come down. That's the big question.
I mean, it's based on our view, not a recommendation to buy or sell.
Yeah. Of course, that is only one. I can throw in more, right? But then at the end of the day, you really need to do your own research. You need to know what you're doing. Otherwise, the next moment, interest rate hike. So we're all expecting that to come down, but then it hikes. Then the price might drop. In my panic. Okay, so that's why it's very important to know what you're doing. Okay, and also diversify your portfolio. Don't throw all your money in. Rusmin say CICT. Throw all your money there. No, So in the Dividend Machine, we will teach you how to diversify your portfolio. Make sure that you actually reduce. You need to manage the risk on the portfolio.
Your portfolio should not be 100% risk. I know of people who go 100% risk. There's no way you should do that. Right?
Why is that so? Because REITs are sensitive to interest rate hike. And I always tell our members that you might want to hedge it against bank.
Banks.
Because if the interest goes up, bank will benefit, REITs will come down. But interest were to come down, bank will not benefit, they will come down, REITs will go up.
But anyway, if you invest in REITs, you're not diversified. Even if you invest in 10 REITs, this is basically in one sector. So you're just affected by everything that affects REITs.
But actually, within the REITs, there are many subsectors.
I know, different industries.
But it's still classified as a property.
Okay. So CICT is one good example at this point in time. I think a lot of people know the quality of CICT. I mean, if you live in Singapore, you will know all of their malls and their offices and stuff like that. And it's like these are major buildings in Singapore. And to basically have the yield now at more than 5%, 5.6, is it?
5.5, 5.7. They're about 6.
I think some people could be interested in that. So again, no recommendation. Please do your due diligence and your research. But it's just an example of where REITs are right now. Because in terms of price to book, they're cheap. Yields are very decent. But the top quality ones, I don't see them being affected drastically in the near term. We don't see that coming. So do check it out for yourself if you want to have a look at that. But you mentioned interest rates. That's one risk. Any other near-term risks that maybe, if people are looking at REITs right now, any other near-term risks that you should consider?
First of all, every REITs have their own individual risks. Depending on which sector that they are in, the supply and demand dynamic can be very, very different. So there's a risk they need to take out for. But I think the major risk that everyone is watching out is, of course, is your interest rate risk. And if you are investing in REITs that have overseas exposure, that will be your currency risk itself. And
you need to understand that market overseas as well. Because it's easy to understand Singapore if you live here, and it's a small country. It's a small space. You can't know how property is being used up here. There's not a lot of it. There's not a lot of land here. But overseas is a different dynamic as well. So if you invest in a REIT with overseas assets, you need to understand that as well. So lots of things to have a look at whenever you look at a REIT. It's not just like you say, like throwing a dart and pick a good one. So if you're interested, do check out dividendmachines.com. It's now open for enrollment until 17th of March 2024. We'd love to have you there and teach you all these things as well.
Once you miss it, we'll see you next year. 2025.
All right. So I think that's pretty much it for this thing. I think we just wanted to share it with you because we've been doing this for 8 years. Rusmin has been writing an article every single year about Singapore REITs. Basically, you also do it for Malaysia and Hong Kong REITs as well.
But Singapore is a lot more exciting.
Singapore has a pretty good list of REITs actually. And if you're interested, you can just check out our website as well, fifthperson.com. You can search for it. I think it's one of the top articles right now. But basically, you can go through the years, go back through the years and see how the table has shifted throughout the years as well.
Yeah.
But you can tell it's pretty consistent as a whole, and then things do shift in between as well. But as an asset class for Singapore REITs particular, I don't know, but I can't say for every single country. It's pretty consistent. Yep. And the yields are stable. The capital gain is actually pretty decent as well.
Yes.
And the CAGR is pretty good for some of them.
Yep.
Yeah.
So
you get to receive passive income without doing anything.
Yeah. So for those who actually want to invest for income, you can consider REITs as a vehicle.
Yep.
All right. So with that, is there anything else you want to share about that?
No. Yeah.
Okay. So do check out, the article if you want. It's pretty interesting. And of course, maybe it's time to have a look at REITs.
Yeah.
Yep.
Okay. So my name is Adam. That is Rusman.
Yep.
That is
Thank
Victor.
you.
Thank you so much for joining us. Any questions about this, put them in the comment section. If you like this roundtable, please hit the like button. Tell us you're doing a good job. Subscribe to our channel. And please check out dividendmachines.com from now till 17th of March 2024 if you want to learn how to build a portfolio of dividend stocks and REITs that pay you passive income for a very long time. With that, see you around.